Hi, folks. I'm Peter Lemieux. I'm playing around with my technology, so just forgive me while I try to figure something out. We're a couple minutes early anyway, but let me see if I can figure out my issue. Okay, I need somebody to help me out. Somebody on the chat needs to tell me if you can see that question on my screen. Were you able to see a question on my screen? Nobody's answering me. This is a challenge for me. Hold on again. How about now? Can you see the screen now? Questions? I'm going to come off of it, but just let me know. Were you able to see questions then? Oh, okay. Charita did. You try it one more time. I'm only going to hold it up there for about 10 seconds. Just let me see. Tell me if you can see the question. How about then? Did you see it? No. No, 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 no. Try one more thing. So when I change my screen, we're not able to see the questions, right? This is a challenge. Let me think about this, how to make this work. I want to take a life test with you, but I can't get the screen that has the life test on it to show for you people. What can I do? Well, the only thing I can think of, golly shucks. Just a second here. I've got a whole bunch of life questions that I can read, but you guys aren't gonna be able to see the question. So it's gonna make it at best clumsy, if not useless. Um, all right, can you guys see it now? Were you able to see the question at that time? One more time. Premiums paid by an employer for his employees' group life insurance? Was that question visible to you guys? Apparently not. I can download it and save the URL. All right, thank you, Charita. Folks, give me a minute. Okay, Charita, I have it downloaded onto my computer, but it's on a document. It doesn't have a URL. So that's my problem. It is in PDF and it's sitting on my screen, but I can't get the camera to pick up the screen. Isn't this exciting, folks? You come to class and you get to watch this. Well, I know you people have come here to try to get something out of this. Um, yes, I I think so. I can post a PDF. I have to have Melissa's help to get it up on the screen. But all it is a practice life exam. Probably not much different from what you get on Melissa's site with her Quizlets and quizzes. Um, what what I want to do is I'm going to try and experiment with you guys. I'm going to try to read it, even though you won't be able to see it, to see if we can make sense of the question. And if it's too clumsy and useless, I'll just have to come back and do this class once I get some help at doing that. But let's try it this way. And I need you guys to give me feedback. So even though you can't see the question, allow me to read it to you and see if it makes sense to you. The premiums paid by an employer for his employees' group life insurance are usually considered to be, okay, the premiums paid by the employer for group life, is it tax deductible to the employer, partially deductible to the employee, deductible to the tax deductible to the employee, taxable income to the employee? Is that just too difficult to follow with a complicated question like that with just me reading it? Honest feedback would be greatly appreciated. Well, let me say it to you this way. The question was the premiums paid by the employer, and they offered 4 different answers, okay? 2 of them were how it affects the employee. They are obviously wrong answers because the employer's paying the whole premium. What we need to remember is when an employer pays a premium for the benefit of his employees, it's 100% tax deductible to the employer as a business expense. And that's what that whole question is about. I'm going to move on to question 2 to see if I can teach you something. A blank blank life policy combines investment choices with a type of term coverage. So a blank blank life policy combines investment choices with term insurance. What do you think? When we see investment in the question, it should direct us to one type of policy. Anybody want to make a guess at what the policy is that uses investments? No, not a guess. You know it. Okay, tell me. What policy uses investments? That is a code for the answer. Anybody? You didn't know it was going to be so participatory, right? All right, in the interest of time, when we see a question that says, to give you the answer, investment, it's a variable policy. A variable policy takes the amount of money that's going to be your cash value and invests it in the market. It doesn't go in the insurance company's investment portfolio, it goes into the market. So it will vary, right? It will go up in good times and down in bad times. So the key to that question was investment. Investment should send you looking for a variable life. Next question. In order for a coverage on a non-medical insurance application to take effect the same day, the producer must collect a signed application and, all right, a couple of things to look for in that question. It says a non-medical life application. What that means, it's not medical insurance. What it means is you don't have to take a medical exam, that the insurance company will work off of the application alone, not requiring a medical exam. So, what's required to get the coverage going? Color me beautiful. Beautiful is right. You've got to pay the money. Okay. There is no coverage without the money. That is, if I'm making any sense to you now, that's part of consideration. The insured must pay the premium for the coverage to start. So if there's no medical, for coverage to get started, you've got to pay the premium. However, it's still subject to approval by the insurance company. All right? So we're going to try to remember that. Thank you for bearing with me as we try to make some sense of questions you can't see. A life insurance policy which ensures, that's an EN, ensures that the premium will be paid if the insured becomes disabled has what kind of rider attached. A life insurance policy which ensures the premium will be paid if the insured gets disabled has what kind of rider on there to make that occur? Um, I know it's clumsy for you guys to be typing answers. It'd be nice if you could just talk to me, but I would like to give you a chance to at least try that. Um, the policy ensures, which means if you can't go to work, the premium will be paid is accomplished by what kind of rider? It is the rider is exactly what it's doing. It's a waiver of premium rider. That's what we're talking about here. A waiver of premium rider. To try to get something out of our time together here that's helpful to you folks, I want to encourage you to ask questions on the chat box. If I'm covering something that makes all the sense in the world to me, and it's just not making any sense to you, I want to make this helpful to you. Please ask a question in the chat box so that I can explain it. The premium will be paid if you can become disabled is accomplished with the purchase of a waiver of premium rider. You buy that with the policy. Person purchases a family income policy at the age of 40. The policy has a 20-year rider period. If that person were to die 10 years later at age 50, how long will the family receive an income? So what we need to know, there's two policies going on that we can get asked, right? Family income and family maintenance. And they accomplish their coverage with the use of term insurance. It's like a term rider. We have a guy who purchases family income for 20 years and dies after 10. So the question says, how long will the family receive the income? Will they receive it for 20 years, like he purchased, or the 10 years remaining? Okay, I'll try that, Color Me Beautiful, next time. So let's just think about this. Family income, 20-year family income, you die after 10 years. How many years does the family get paid? I should have music playing in the background. Um, Family income, if you want to write this down, is accomplished with decreasing term insurance. So when you buy a 20-year family income, the clock starts now. It will pay 20 years if you die right away. But the longer you live, there will be less years to pay. So in this case, family income for 20 years, you die at 10, there's only 10 years left on your decreasing term. Family maintenance is level term. So if you die after 10 years, you still get the full amount. You get the 20 years. So what you want to do, this is not whole life. Well, it's built into a whole life policy, but you want to think about it this way. Family income is like decreasing term. The number of years you purchase goes down. Family maintenance doesn't, if that's helpful to you. And I will use your advice to read the answers next time. Questions? Write them down. Okay, on the chat box. I really would love to answer questions. I know this is not exactly the way I wanted it, but let's try to see if we can get something done. The next question says, which of the following statements is correct about an agent who's taking an insurance application? So with a question like this, and you read it, you're looking for the correct answer, which means what? Three of the answers, the agent can't do that. And they can only do one. The first one is the agent should avoid asking the applicant questions that may cause embarrassment. The second one, The agent should have the applicant initial any changes made on the application. Number 3, the agent may allow a member of the applicant's immediate family to sign the application if the applicant is not available. And number 4, the agent may answer routine questions on the applicant for the applicant. Absolutely an easy question, because there's 3 things in there we are never allowed to do, okay? We're never allowed to answer questions for them. We're never allowed to get somebody else to sign the application, right? And you don't avoid asking a question if it's embarrassing. If the question's there, you have to ask it. So just by looking at those 3 crazy answers, the right one pops out that you get the applicant to initial an error that's being changed. So I will move on. That actually was not a difficult question. I suppose they're all difficult if you don't know the answer. So if somebody has a life insurance policy where her husband is the beneficiary and her daughter is contingent, under the common disaster clause, if this insured and her husband are both killed in an automobile accident, where would the death proceeds be directed? Number 1, to the daughter. Number 2, to the husband's estate. Number 3, to the insured's estate. And number 4, to a trust fund. Can't be a trust fund because there's nothing in the question that indicates they have a trust fund. The scenario is simply this. I'm insured on my policy. My wife is the beneficiary and our daughter is the contingent. We die, my wife and I die with a common disaster clause. Where does the money go? So we have to know what's a common disaster clause, right? A common disaster clause says what? It says that the insured died first to avoid any confusion. Okay? If the insured dies first, pardon me, I said that wrong. Monday morning, no coffee. Okay? You're right, color me beautiful. It is going to go to the daughter. Common disaster clause says the insured dies last. Cross out what you wrote, say Peter's an idiot, and you write down, okay? Insured dies last. That means at the insured's death, the wife's not in the picture. The money has to go to the daughter. And it's done that way on purpose to avoid what you just said, color me beautiful, it going to the husband's estate. Maybe the husband has got children from a prior marriage, and the insured, she doesn't want the money going to those kids. So by putting a common disaster clause on, it says that our insured, our woman, the insured, dies last. So at her death, the beneficiary is not there, dead. The money must go to the contingent, which is be her desire, right? Without the common disaster clause, if it's determined by the paramedics or whatever that in fact the insured died first, that money immediately goes to the wife, to the husband, who's now dead and gets distributed to his estate, and the daughter gets nothing. So the common disaster clause, the thing you got to remember, insured dies last. That's why we put it in there, okay? I don't know what you mean by 20 years, but that's, we're talking about the common disaster, and it's that kind of day, right? Which of these would be considered a limited pay life policy? A 10-year renewable convertible term, life paid up at 70, straight whole life, renewable term to age 100. Once again, which is limited pay? 10-year renewable convertible term, life paid up at 70, straight whole life, renewable term to 100. Anybody want to play that? Make a guess which is the limited pay? I know this is clumsy. I with deep apologies. We're just trying to do the best we can. Okay, I got you about the prior question. Which is the limited pay policy? Anybody remember the choices? If you don't, I certainly understand. You're not able to see it. So let me go through these and tell you how we figure it out. The first one is a 10-year renewable convertible term. That's not a limited pay life insurance. Limited pay life is a whole life that you pay off early. This is term. It cannot be number one. Life paid up at 70, that sounds exactly correct. A straight whole life is not limited pay because in a straight whole life, you're going to pay until you die. And renewable term is not limited pay life because it's term insurance. So the only answer there that makes sense is a life to pay age 70. Please remember this. A limited pay life is not a new policy. It's not a policy like term, whole life, universal life. A limited pay life is a whole life policy that you pay off early. It's still whole life. Cash value is going to equal death benefit at 100. And when you die, your beneficiary is going to get the money. Your payments stop. And how you do that is you pay a higher payment. Remember, if you want to shorten your mortgage from 30 to 15 years, you got to increase your payments. Same too with a limited pay life. I want to pay this off early. No problem. Now pay us instead of 100 a month, 130 a month. And then you will have it all paid off at 70 or whenever you say. Making sense? Thumbs up, thumbs down. Next one. A traditional retirement IRA annuity. So somebody has an IRA, they put the money into an annuity. Distributions must start by 59 and a half, 65, April 1st of the year following 59 and a half, April 1st of the year following 70 and a half. This is distributions must start by a certain date. Let's simplify it. 59 and a half, let's say 60, 65, or 70. You got an IRA, you can't take it out before 59 and a half, right? You got to wait till you're 60. But if you don't take it out at all, there's a year that if you don't start taking it out, you're in trouble. That's what we're looking for. What age is that? Color Me Beautiful. You're doing a great job today, by the way. I'm not picking on the rest of you, but Color Me Beautiful is in line for the Class Donut Award, which I mail you a donut when you get it. It's about 2 weeks old. April 1st, following you're turning 70 and a half. I don't want to mess with you, but that law just changed. But let's remember this for the test. 59 and a half, you can't take it out before then. 70 and a half, if you're not taking it out by then, you got a penalty. All right? Again, I am very sensitive to the fact that this is a difficult way to do this, and I apologize. What's considered to be a characteristic of an immediate annuity? Words. We got to get the words. An immediate annuity. Benefit payments start within one payment period of the purchase. Benefit payments start within 5 years of the purchase. It's tied to a stock index. Benefit contributions begin immediately. Within one payment period, within 5 years, stock, or immediately. Anybody remember this? So this uncomfortable Silence that everybody hates. Oh, talk to me. Don't have silence. Here we go. An immediate annuity in my pea brain says you give the money to the insurance company and they start paying you immediately. But that's not the right answer. If you take payments within one payment period, they call it an immediate annuity. What the heck's a payment period? Well, if you tell the insurance company, I'm going to give you money and I want to pay every year, if within the first year you start your payments, it's immediate. Within the first payment period. Usually it's 1 year, usually. Now, the other answers were 5 years, that's not immediate, okay? Interestingly enough, it is not that the payments start immediately, because that would make sense, right? It's within the first year if you start your payments. It's considered excuse me, it's considered an immediate annuity. Dylan, I got you. This is crazy. I understand that. And mea culpa, my fault. Okay. I got to fix this. You should be seeing the question. So I understand your frustration. I am equally, if not more frustrated. I'm trying to make the most of what we can in my time with you. Okay. Let's go on to the next one. USA Patriot Act. When was it enacted? 2001, 2002, 2003, 2004. Does anybody even know what this is about? The USA Patriot Act, and when was it enacted? Is this like Greek to everyone? You don't even know what it's about? Well, allow me to do a couple things. The USA Patriot Act gave the government authority to check into situations that could involve terrorism. It was enacted right after September 11th. Now you got to know, what year was September 11th? September 11th was 2001. Now, this probably would never be on your test, but just for your knowledge of American history, September 11th, 2001, World Trade Center went down on a terrorist attack, which triggered the USA Patriot Act. So, more a question about American history than insurance. Which of the following offers an insurance applicant the right to review the contract and receive a full refund? Is that our free look period, probationary period, elimination period, or refund period? What do we call that period of time where you can review it to get a full refund? Thank you, Dylan. We call it free look. I would think most people would get that question right unless you just didn't study, because it's refund provision sounds right, but it isn't. We call it a free look, right? So if you've studied, you're going to get that. Okay, so they give names in here that are stupid, so I'll just make up names. We're going to use people in the class. Dylan is shopping for a permanent life policy that will offer the most protection per dollar of annual premium. Which of these policy is likely to fit the need? An endowment, a straight life, a 10-year renewable term, or joint life? Most protection for the dollars of coverage. You're going with endowment, Color Me Beautiful, or was that the last question? A is endowment. Is that what we want? No. Just bring me into your test and I'll shake my head no when you got a wrong answer. Forget the answers they gave you. What insurance is going to give you the most protection for the least dollars? What's the least expensive life insurance policy called? All right, let me say it another way. Thank you, those that are trying here. You need $1 million of insurance as soon as possible to cover your debts. And I'm assuming we're not all flush with thousands of dollars of cash to pay that premium. What's going to be the lowest priced policy? Thank you, Color Me Beautiful and Pauline. Term. Term is death benefit only. You get the most coverage for the least outlay. Now, you don't get something for nothing. Because it has the least outlay, it's got parameters like it's temporary. It isn't going to last the rest of your life at that rate. Okay. But for now, it'll work. Okay. So term is going to be the answer for somebody who needs the most protection for the least dollars. Okay. Let me pick on somebody else in the class to try to make sense. Pauline. Okay. Pauline owns a $25,000 life policy that pays the face amount when Pauline lives to age 70, or to the beneficiary if Pauline dies before the 70. What kind of policy does Pauline own? Let me say it again. 25,000 death, 25,000 goes to the beneficiary. But at age 70, if Pauline is still alive, they pay the 25,000 to Pauline at age 70. Is that straight life, modified life, whole life paid up at 70, or endowment at 70? Ooh, there's a spooky one. What do you think? So, Pauline, what you're saying to me is that if you bought a whole life and you were alive at 70, they would give you the death benefit as the insured? What do we know about whole life? Cash value equals the death benefit at what age? It's not 70. It's 100. So it's not a whole life. That won't have that much cash in it at 70. Right. So this is not a commonly taught or asked policy. It's an endowment. Okay. An endowment. Some of you guys may not have even had it in your test material. I don't see that it's asked very often, but an endowment policy matures at the endowment date, which means that if Pauline bought an endowment at 70, Pauline would get the full death benefit as if she were 100 and bought a whole life. Endowments are very expensive. To accomplish that kind of cash value growth, you have to pay a lot of money. I don't even know that they're sold anymore. Okay. But for Pauline to get the whole death benefit at 70, she had to own an endowment. Anybody want to? It's not a commonly asked policy, but what it is it matures before 100. Okay, whole life matures at 100. You could get an endowment at 65, where if you live to 65, they pay you the whole death benefit at 65. It's expensive, but it exists. Cupcake, are you taking life only, life and health? Life and health and annuities. Well, this is a limited parameters class. I'm only doing life questions, and because of my technological failure, I'm unable to show you the questions. So I would suggest to you that hang around and see what you can pick up and take notes, but certainly explore other classes and videos from Melissa. Okay. This policy sounds crazy. Well, I don't have a single insurance company that even sells them anymore. Okay, so maybe they are crazy. I've never seen it on a test, but shows up in practice tests, so some states must ask it still. Um, what kind of policy either pays the face value upon death to the insured or when the insured reaches 100? Term, whole life, credit life, universal life. Should be an easy answer, right? Pays the death benefit when you die or to the insured at age 100. What policy is that? What policy does the cash value equal the death benefit at 100? Thank you, Cupcake. Whole life. I guess I got to call you your whole name or you'll think my conversation with you is inappropriate. Cupcake Facts Journey. All right, let's move on. Which of these is not an element of life insurance premiums? All right, let me explain the question. To make a premium, an insurance company puts three elements into the premium. They have to charge you for three things so that they have enough money to stay in business and pay their claims. And this question is asking about those three elements. The answer to the question lists the three and lists one that's not in the premium. Number one is mortality rate. Number two is insurer's expenses. Number three is interest credit. And number four is morbidity rate. Now, I want to explain this because you guys can't see this. You're probably not going to remember these just by me saying it. Well, I'm going to read them one more time and just give you 10 seconds to tell me if anybody knows the wrong answer. Mortality rate, insurer's expenses, interest credit, or morbidity rate. One of those is not an element of life insurance. Does anybody know that before I go and do my brilliant analysis? Okay, no one spoke, which is, whether you mean it or not, is one more time. Mortality rate, insurer's expenses, interest credit, morbidity rate. Color Me Beautiful is voting for morbidity rate. I know this is clumsy for you guys, but for some bizarre reason, I'm having fun. So just pray for me, okay? The funny farm truck will come and pick me up soon. Okay, here's the truth. To make a premium, the insurance must collect enough money to pay the death claims. If you don't have enough money to pay the death claims, you're out of business. That's called mortality charge. How long are people going to live? Mortality. Mortality charge is a necessary expense. The second element is they have to charge you for their expenses. Running an insurance company isn't free. You got offices, utilities, labor, commissions, advertising, all these expenses an insurance company has just to do business. They got to get that from you. That isn't gifted to them by God. Okay. So they got to charge you for the death benefits. They got to charge you for the expenses. If they don't collect enough to pay those two, you're going to have a company go bankrupt. But then there's a third element that's kind of interesting. Since in life insurance, you give money to an insurance company and they're going to pay you at some date in the future. It's not like a bank where you give it and you take it out tomorrow. That money's coming to people in the future, which means the insurance company gets to invest it. And they assume they're going to make a certain amount of interest on investments. That interest actually lowers your premium. They give you an interest credit. I'll just kind of make it. You give me $100 okay, for your premium. But we invest it and we're going to make 5. So you only need to give me 95. It's not as simple a math as that, but the concept is the same. They charge you for mortality, they charge you for expenses, and they credit you with interest earned on your money. And that's your premium. The fourth one was called morbidity. Morbidity has nothing to do with death, it has to do with medical charges. We use mortality and morbidity in health insurance where we got doctor's costs, hospital costs, etc. Morbidity is a factor in a health insurance premium, not a life insurance premium. In life insurance, 3 elements: mortality, expenses, and interest. But interest goes as a credit to you, it actually lowers your premium. So if you want to write them down, I understand getting confused. That's why they give tests. They teach you stuff to confuse you and then give you a test to mess with you. But, anyways, elements of a life insurance premium is very learnable. It's only 3 things: mortality, expenses, minus the interest. And that's your premium. Mortality, expenses, minus the interest. And that might be one question on your test. But hey, people or fail on 1 point, okay? Plus the fact it's good to know how these policies actually work. So we got a key employee at ABC Incorporated. So let me pick on Cupcake. Cupcake works at ABC Incorporated. If a key employee life policy is purchased on Cupcake, which of the statements is true? Cupcake owns the policy, is the insured, and the beneficiary. I don't know how an insured can be a beneficiary, so I don't like that answer. ABC, the corporation, is the owner. Cupcake's the insured. ABC is the beneficiary. Number 3, Cupcake is the policy owner and the insured, but ABC is the beneficiary. And finally, ABC is the policy owner. Cupcake is the insured. Cupcake's spouse is the beneficiary. So what we're talking about here, you're not going to remember all those lines. I mean, that's a lot of words, okay? Key person life insurance is always purchased on the life of a valuable employee. Here's how it works: the business owns it, the business pays for it, the business is the beneficiary. The employee, in this case, Cupcake, is only the insured. That's it. Cupcake's the insured. If Cupcake dies, the money gets paid to the employer. It's all about the company, the business. Business is protecting themselves. They own it, they pay for it, they're the beneficiary. Cupcake, this great employee, is merely the one being insured. That's it. So that's what a key person life insurance policy, owned by the company, paid for by the company, company's the beneficiary. So let's try to lock that one in. To be valid, a group life insurance policy. So in other words, there's rules in group life insurance. To be valid, you got to fall in those rules. To be valid, the group must be issued to a grouped form solely for the purpose of obtaining insurance. Number 2, may not be issued to a group formed solely for the purpose of obtaining insurance. One is must be, and the other is can't be. May not extend coverage to dependents, may not subject individuals to standards of insurability. This is an interesting question because technically there are 2 correct answers here. Now, I don't know if you're following me or not, but group insurance doesn't ask the employees to prove their insurability. It's issued without health questions. But that's not the right answer to this question. This question asks, can a group be formed just for the purpose of buying insurance or not? Those are the first two answers. One is yes, the other is no way. And they can't. Okay, so it can't be issued to group who are only together for the purpose of buying insurance. That would be the correct answer here. So let me give you an example to make my point. We have a wonderful community here, 7 very patient people putting up with this without seeing the questions, and me. And we have a barbecue to celebrate passing the test. At the barbecue, people say, listen, it's cheaper to have group insurance than individual. Why don't we as a group buy group life insurance? And we'll call ourselves the barbecue club. Can't do that. There's no reason for you to exist other than to just buy insurance. That won't work. So what does work? If it was a company and I was the employer and you were employees, absolutely. We exist for the business. Now we're buying the group for the business. But you can't exist just for the insurance, okay? That's a principle of this question. So a policy owner is able to choose the frequency of premium payments. What is that feature called? Is that consideration, pay or benefit, premium mode, or assignment provision? The ability to choose your frequency of payments. Consideration, pay or benefit, premium mode, or assignment provision. What is that ability to choose premium mode? I think gave you the answer. It's your mode. The mode of payment is monthly, quarterly, semi-annual, annual, how often I pay my premiums. And that's all that question was about. That was one of the ones that helps you get your passing grade. Group life insurance, we're back to group life insurance policies, are generally written as a term rider, annual renewable term, increasing term, or group whole life. What was the answer to that one? The answer to that one was premium mode determines how often you pay your premium. Okay, now group life insurance policy is usually written as a term rider, an annual renewable term, increasing term, or group whole life. So you go to work for the ABC Bank and they say, we're giving you group insurance. What kind of insurance is that? Pauline wants to go with group whole life. Is that right? Group whole life, cupcake? Have any of you ever worked a place where you had group life insurance? And did that insurance have cash value in it? No. It's death benefit only, which means it has to be some form of term insurance. Okay? Can't be whole life. So is it a rider, annual renewable term, or increasing term? I'm not going to torture you people. Okay? It is not increasing term. That would be very rare where it says we're going to insure you for 25,000 and every year after this is going to get bigger and bigger and bigger. So if you work at the bank for 40 years, you could have 125,000. It keeps growing. They don't work like that. They just give you a flat amount of insurance. Okay. And that is best done with an annual renewable term. Now, let me break that down. That means we take the average age of the group today and we charge that rate. Next year at renewal, we take the average age of the group and we charge that rate. Every year, we change the rates on the group. If the group doesn't hire any new people and the people just get older and older and older, the rate will go up. But that's not the way most businesses work. Most businesses work, some people leave, get fired, and they hire new people. So every year we calculate what's the age of the people working there now, and that'll be the rate for that year. The next year we'll do it again. That is, listen, annual renewable term. And it's the least expensive rate the business can capture for the life insurance. It's a annual renewable term. It can't be a rider. A rider has to be put on top of another policy. It doesn't exist on its own. Okay? And you have to buy a policy. You can't just buy a rider. So annual renewable term is the one that works. Are we okay? Marginally, friends? I'm not even asking for that anymore. Just moving along. Okay. Let's look at another question. So let me see. I got to pick on somebody else in this class. The same three people. Sandra. Okay, Sandra, we're going to pick on you. Sandra is I already asked that question. If Sandra is the insured, no, I'm sorry. Sandra, you're going to get in the next question. If the insured and primary beneficiary are both killed in the same accident and it cannot be determined, that is a messed up question. I've got to skip it. If you could see what I'm doing, you'd understand. When an insurer issues a policy that refuses to cover certain risk, this is referred to as elimination, exclusion, limitation, or exception. Now, this is vocabulary question. All those words could be true, but you have to learn the exact language of insurance. Only one is true to an insurance company. If they refuse to cover a risk, is that elimination, exclusion, limitation, or exception? Look at you guys. At the end of the class, I'll just give you a passing grade on the test and you can go get your license. You're so smart. Exclusion. I don't always tell the truth. Okay, that's an extra benefit you have to pay for. Next question. Which of these factors does not influence an applicant's need for life insurance? You know, folks, passing the test is really paying attention to the question. We miss so many questions that we really would know the answer to if we read the question correctly. Okay, so you don't get the benefit of seeing this, so you're working at a huge disadvantage. Which of these factors does not influence the applicant's need for life insurance? What makes me need life insurance? The lifestyle of the applicant, the number of dependents, future educational cost of the dependents, or self-maintenance. Which of those does not change how much insurance you need? Your lifestyle, the number of dependents, educational cost of those dependents, self-maintenance. Which of those would not have anything to do with your need for insurance? Well, a couple of you are flirting with lifestyle. Let me just say this. If someone were to have a dangerous lifestyle, they might be more worried about, I really need to get some life insurance. So I'm not sure that's the answer you're looking for. Education of your dependents would be. If you want to educate your dependents, you would need more life insurance. But the one that stands out, BJ, congratulations, self-maintenance. If you're determining how much insurance you need for your family, you got a spouse, you got children, your country club membership and the amount of money you spend at that country club on yourself, your golf clubs, your all that stuff, when you're dead, not a factor. Okay, you don't need insurance to keep you going because you're not going anymore. Self-maintenance is not a factor. Your hobbies, your your avocations, your things you do. Um, you like to take golf trips with your buddy every year. When you're dead, that expense is gone for the family, but they still have to educate the children. Okay, the number of children might need more insurance. Your lifestyle, what we're meaning here is some people are in such a dangerous lifestyle that they're motivated. I really need to get insurance because the lifespan of this particular job, working in coal mines, isn't very hot. But self-maintenance is not a factor. Okay. We don't, what you spend on yourself, on your car that you spend so much money on, when you're dead, we're selling that thing anyway. Okay. So let's just tell the truth. Okay. Now, who is it? Sandra. We're going to pick on you now. Sandra is the insured on a participating life policy. Oh, language. I got to remember participating. On a participating life policy, which statement is true if Sandra's premiums are waived due to a disability? Sandra cannot borrow on the policy's cash value when she's disabled. True or not? Sandra will have to pay income tax on the amount of premiums that are waived. True or not? Sandra can still receive dividends. Sandra cannot assign ownership of the policy when the premiums are being waived. Which statement is true? 3 of them are not true. So let's take them one at a time. Sandra's disabled on her whole life policy. The insurance company is paying the premiums. Can Sandra take a loan out on that policy? Absolutely. The policy is active. Premiums are being paid by the insurance company, but it's active. Sandra can take a loan out. Number 2, will Sandra have to pay income tax on those premiums that are paid by the insurance company? It sounds like she would, but she doesn't. Okay, it's a benefit she paid for. She bought a waiver of premium benefit. It's an insurance benefit, is not taxable. So you probably didn't know that. The third one is, can Sandra still get dividends? And the answer is yes. The policy is active. Okay, it's being paid by the insurance company. That means the one she can't do, she cannot assign ownership of the policy while the premiums are being waived. So let me talk about this. Color me beautiful. You made a comment that most of our students make. Tax questions always get me, you said, caught up. Tax questions can give you Excedrin headache number 5. No question about it. The first thing I want everyone to just be aware of as a means of encouragement, there are actually very few tax questions on your test. Take a look at it. You might get on a 100-question test 4 or 5. It's not 20. Okay. So if you can get, say you get 5 and you're able to scramble up and get 2 of them right, you're only down 3 points on text questions. And it's one of our most complicated ones. So I don't want you to lose sleep over the text questions. I do want you to try to learn them. Try to get as many of them right as correct as possible. Okay. But don't let fear of tax questions hurt your confidence. Okay, please. A retirement plan that sets aside part of the company's net income for distributions to a qualified employee plan is a rollover, a 403B, profit sharing, or salary reduction. Again, there's not a lot of questions on tax qualified plans, but this question here is an example of the clues in the question can send you to the correct answer. Let me read it again. The retirement plan that sets aside part of the company's net income for distributions to a qualified plan. Rollover, 403B, profit sharing, salary reduction. I contend that because we're giving you our net income, that means what is net income? It's after all you paid all your bills. This is the money you made. That's profit. Okay, the net income is your profit. So the answer is profit sharing. So sometimes just kind of taking a deep breath and saying, I don't know the difference between 403B and uh, rollovers and stuff like that. Read the question. Net income. What's net income? It's the income you have left after you've paid all your bills. That's what we could call a profit, right? So there's looking for the clues in the question can be very, very helpful. The next one says, what's considered a valid reason for small businesses to insure the lives of stock shareholders? So at this stage of putting up with this for flirting on an hour, our mind can wander. Okay. So I want to try to get you focused. So you got a small business and they want to insure the lives of shareholders. All right, let's just before we get to the answers, what's a shareholder? Can you guys got a picture of what a shareholder is? Is it the company? Is it employer? Is it the employees? It's people. Thank you, Sandra. And Lauren. It's people who own stock in that business. They don't work there. They don't run it. They just own the stock. Okay. Now, this company wants to put insurance on a stockholder. What would be a reason for doing that? Okay. And it says here to provide income for the surviving dependents. Okay. Do we like our stockholders so much that we want to give their family money when they die? To reduce the company's tax liability? I don't think that has anything to do with it if a stockholder dies. Okay. To pay for final expenses? Sure. But why would we want to pay final expenses for all of the people who own stock in our company? Fourth one ends up being the correct answer. And it is, my friends, to fund a buy-sell agreement. Rachel's still in the donut. Okay. I'm so impressed with this answer. We got this 2-week-old donut we send out at the end of class, and that was a wonderful answer. So what happens is when we would insure a stockholder is at their death, we want to retire their stock. We don't want that stock going to their family. Now, don't think of General Motors or big companies like that. Think of Sally's boutiques, right? And she's a corporation and she's got stockholders. And her partner's a stockholder. Her partner dies. She doesn't want to do business with her partner's family, right? They don't know anything about the boutiques. So she buys insurance on a stockholder so that she can retire that stock and own the company. So I want you to please remember it this way. Buy-sell agreement is a company insuring owners. A stockholder is technically an owner. Buy-sell, we insure owners. Key person, we insure employees. Write it down. Key person, we insure the employees. Buy, sell, we insure owners. Okay. Thank you, Rachel. Great job. It's a jelly donut too, by the way. Okay, which of the following is an example of defamation? There's what we call unfair trade practices. It's You can't do these things, okay? Defamation is one of the things we can't do. But what is it? Okay? When I teach about defamation, I say it's talking smack about other companies and other agents. That won't be on your test, okay? There won't be an answer that says talking smack. Here's examples. You got only one is an example of defamation. A pamphlet listing a competitor's financial rating. Number two, a brochure including an untrue statement regarding your competitor's ability to pay claims. Number three, a verbal statement of a competitor's complaint ratio. And number four, a truthful estimate of dividends. Folks, this is a very easy question. Three of them are furnishing the people with true statements. One is a brochure including an untrue statement. That's always the wrong one. Okay, very easy question. We cannot lie or give people untrue anythings. Okay, if that's suggested that you can do that, that's a wrong answer every time. I mean, if one thing the state wants you to do is be truthful and thorough when you explain policies to people, right? Truthful and thorough. Don't give incomplete information. So we'll move on to another question, might be more challenging. If a producer is found to be writing primarily controlled business. Now, if I don't have any idea what controlled business is, I'm guessing this one. Okay, it's like blindfold me and let me shoot a dart. So you got to hopefully know a little bit about what controlled business is. If a producer is found to be writing primarily controlled business, number one, the producer will be forced to return all commissions to the insurance company. Number two, the commissioner of insurance will have that producer imprisoned. Number three, the commissioner will not renew the license. And number four, the producer must assign a portion of the business to another producer. Okay, let's talk about controlled business. At its base level, it's you selling insurance to your family members. And the states don't want you selling more than 50% of your business to family members. You're supposed to get a license to sell to the public, not just to give your family insurance discounts. Okay. So you end up at the end of the year, 60% of your business is going to your family. What's the likelihood they're going to throw you in jail for that? Zero. Okay. What's the other one? Make you give all your commissions back? I'll just tell you, between you and me, that doesn't happen. How about assigning some of that business to another producer? Makes sense? Not likely to happen. The most likely scenario, and you maybe didn't read this, is the commissioner will just say, okay, we're going to take your license away. And the simplest way to do that is when it comes up for renewal, we won't let you renew. But the other ones are not likely to happen. Okay. Just a question of what makes them. Are you going to throw a guy in prison because his family bought a lot of insurance? Or no. Okay. Not going to make him give the commissions back, but you're going to stop him from selling more insurance by affecting his license. Okay. Let me pick on somebody. Rachel, you get to do this one. Rachel died. I'm sorry to hear that. 5 years after purchasing a life policy. While investigating the claim, the insurance company discovered material misrepresentations made by Rachel during the application process. Which of these actions will they take? Material misrepresentations mean she lied on the application about something very important. Okay, beneficiary will be denied the claim. The beneficiary will be denied the claim and refunded all paid premiums. The beneficiary will get the death benefit. The beneficiary will get partial death benefit. What do you think? What's the key on this question? BJ says they're going to pay the claim. Let me tell you something. There's never partial payments. The insurance company pays it or they don't. Okay, so throw that one out. Look at Rachel. Man, she wants that jelly donut bad. It's over 2 years. Our incontestability clause says that if a policy is 2 years old or longer than 2 years, the insurance company must pay claims for fraud and suicide. So Pauline, I think it was Pauline or Sandra, one of you scoundrels, did commit fraud. But because the policy is over 2 years old, the insurance company has to pay the claim. And so this is how they test you. You see fraud and you say, no way they're going to pay that. Got to remember the 2-year rule. They distinctly said the policy was purchased 5 years ago. So watch these guys when they give you test questions. They love to give you, you got to learn how to hit the curveball, okay? You can't just get simple fastballs on every question. And if you don't know what I'm talking about, I pity you. And I like baseball. Next question. A limited pay life policy has graded death benefits, no cash value, premium payments limited to a specified number of years, payments paid to 100. So instead of asking you, I'm just going to walk this through. A graded death benefit. You may or may not be familiar with that policy. Picture, maybe you can't see this, in construction, when they do grading, leveling off the land or creating a little bit of a grade so the water will run downhill. Grading is pitching things up or down. A graded death benefit, the benefit goes up or down according to a grade that they create. It's a changing death benefit, but it's guaranteed. It's not like the stock market. It's guaranteed to go up a little bit a year or down a little bit a year. You can call those policies a graded policy. That's not the right answer here. We're looking for limited pay life. Has no cash value. It's life. Life means whole life. It will have cash value. Premium payments limited to a number of years. Bingo. Payments paid to 100. No, that would be a whole life. But limited pay life squishes in the payments to a limited time. Okay? So that's how we think that stuff. What group term life feature permits an individual to depart from the group and continue to be covered without proving evidence of insurability? Now, surely you can picture this. You got group term, an individual leaves the group, but is allowed to continue on the group coverage without proving their health. Is that entire contract? Owner's rights, non-forfeiture, or conversion? I misread the question, my friends, so forgive me. They continue to be covered without proving evidence. It did not say stay on the group, just continue coverage. So entire contract, owner's rights, non-forfeiture, or conversion. BJ, conversion. I want to take a minute to just chat with you about conversion and COBRA. In both those examples, our client is on group insurance. leaves the group but can continue coverage without proving their health, meaning they have stage 4 cancer, but they can keep coverage. That's a good deal. You can either convert, which you must do within 31 days, where you would get an individual policy from that insurance company that had the group. It's a right of conversion. Now you're going to pay individual rates, not group rates, but you're going to own the policy yourself. Or you could go on Cobra, right? Cobra you have to do within 63 days. I know my problem here. Cobra is primarily used in health insurance. Got to figure that one out. Life insurance uses conversion. Cobra, we don't have Cobra coverage on life insurance. I just didn't get enough coffee this morning. So the only answer in life insurance is conversion. Okay. In health insurance, you can do either convert or Cobra. So trick the teacher. A universal life policy is sometimes referred to as an unbundled life policy because the owner can see the interest earned, expense charges, and you get an annual report that month by month shows you your interest, your expenses, and one other thing is shown: your inherent risk, the commissions paid, the inflation factor, or the cost of insurance. You got interest paid, right? Expenses taken out of your policy. And what's the third thing you see? Rachel coming in. Yeah, it's how much they charge you for insurance. 3 factors affect your account value every single month: how much they took out for insurance, how much they took out for expenses, and how much interest you earned. Now, the other factor goes on the account is how much money you paid in. But on account, it just looks at what came out of the account. Okay? Those are all on a universal life policy. A policy that becomes a MEC. Oh boy, everybody love MECs, modified endowment contracts. Let's see if we can figure this out. A policy that becomes a MEC, number one, will no longer allow for policy loans. Number two, must be placed in an irrevocable trust. Number three, can never be reinstated after a lapse. Number four, will lose many tax advantages. Which is the main feature of a MEC? How are we doing on MECs? Mackenzie Lee. You're right. Mackenzie Lee is a plant. Mackenzie Lee came in here as an instructor trying to change the curve of the class. I made that up. So let me just take out your crayon, pencil, pen, whatever you're writing with, and write this down. If you fail the 7-pay test, whatever that is, but write it down, 7-pay test, your policy becomes a MEC. Now, let's not talk about 7-pay test right now. What's a MEC? A MEC means it's going to be taxed as an annuity and not a life insurance policy. Trust me, that's not as favorable. You get more tax breaks in life insurance money than you do in annuity money. So they're going to take this life insurance policy, even though it's a life insurance policy, but you lose tax advantages. When you fail the 7-pay test and become a MEC, you lose tax advantages. If you just keep it at that level, that will help you understand this. Now, the other factor is, Peter, what the heck is a 7-pay test? It's exactly what it says. Everybody knows 7-pay test, right? Insurance company says, how much money will it take to pay off your policy as a limited pay life in 7 years? What's the amount of money? That's the most money you can put into this policy, because what people want to do is they want to load up a universal life to get a lot of cash value, which they can borrow and leverage, right? As long as it's a legal policy, that's okay. But the 7-pay test says if you're putting too much money in there to make your cash beyond the limits, they will turn it into a mech and now you lose tax advantages. So that's a simple way of saying that. If you want to become an expert on 7-pay tests and mech, have at it. Study and everything like that. When you take Melissa's gold classes, okay, she's going to explain all that in detail. Or here's a secret for all my fans. If you go on YouTube, you're on YouTube now, Insurance Exam Queen, there's a button that says subscribe and another one says join. Click the join. This is like secret code. Click the join button. If you do, I teach in detail all 16 chapters of life and health, which you on video, which you can have for 25 bucks. 25 bucks. That's the best deal since they invented cotton candy. Yeah. Click join. You can get all my teachings on life, all my teachings on health for a month. If you want to continue for another month, you got to pay another 25. But for a month, you can pick out the chapters you want. If you enjoy my teaching and you think it makes sense, you can do that. Melissa has a subscription for PNC, and she also got her gold courses. But that's just a little commercial if that's helpful. Insurance Exam Queen, YouTube, Insurance Exam Queen, join. Okay. How can you get the gold class? Just go on Insurance Exam Queen, and they've got the different ways to join for the Melissa's gold class. Okay. I'm going to do 2 more questions, and then I'm going to call it a day, and I'm going to dedicate myself to fixing this problem. So when I teach a test again, you guys will actually see the question, and I apologize for that. Next question says, what action can a policy owner take if an application for a bank loan requires collateral? You can utilize accelerated benefits provision. You can borrow against the cash value and use it as a down payment. You can assign policy ownership to the bank, and you can name the bank as beneficiary. Well, there's an answer that they want from you. Thank you, Sandra. Sandra says assign it. In learning about assignments, there's 2 assignments. Absolute, where you give ownership in total to somebody. They own the whole policy. Or collateral assignment, which we would do in this case, where the bank is entitled to how much you owe them from the policy. Should you not make payments, they could go in your cash value and take out what you owe them. If you die, they can collect what you owe them from the death benefit. That's a collateral assignment. Let's just look at the other answers. Accelerated living benefits cannot be used because that's only available if you have terminal illness or going in a nursing home. Can you borrow against the cash value and use it as a down payment? Technically, yes. It's not against the law. But they want to know the bank, what action can the policy owner take if it requires collateral? Down payment won't serve as collateral. And naming the bank as beneficiary is overkill. You don't need to give them all your death benefit. Just give them a collateral assignment. Last question for today. ABC Insurance Company has accepted a life insurance application. It contains unanswered questions. That might be the agent's fault. We're supposed to make sure they get answered. The company then makes the application part of the life contract. In this situation, the insurer has waived one of its legal rights, issued a voidable policy, committed an act of fraud, forget that, okay, assigned the risk to reinsurer, obviously not that. So which is it? Is it a voidable contract, or did the insurance company waive one of its rights? Little disagreement in the crowds. One says B, one says A. The way the law looks at that is the insurance company has this application. They see you haven't answered questions, yet they still issued the policy. By doing that, they waive their rights to know those answers. If they wanted to know those answers, they would get back to the insured and said, hey, we can't approve this till you answer these questions. But by issuing the policy, it's not a voidable policy. The insurance company, by law, has waived their rights to know those answers. When you get unanswered questions and still get approved, the insurance company has no rights to know those answers because they waived them. And that's what we say. So, my dear friends, I want to thank you for coming. I want to thank you for your patience. This was less than ideal in my mind. You can't see the boil in my veins, but I'm upset that you couldn't see the questions. I'm going to get that fixed. I really appreciate your hanging in here. Hopefully, we shared some information that was helpful. Insurance Exam Queen, our goal is to help you pass the test. Use us. Use Melissa, use her programs, things like that. If you think that my videos on chapters can help you, click join when you're on the YouTube Insurance Exam Queen. Join, and you can get all I think there's 16 classes I taught for $25, $26. So, anyways, it's been a pleasure getting to know you guys and being in the class. I wish you the best, and come back and see us again. Thank you for coming.